clients tend to be very emotional about their money. It's quite logical. They've been spending their lifetime earning that money and now they want to preserve it. And sometimes they have reaction factor which works well in real life but doesn't work well in the financial market. Strategic asset allocation is the key element of every given portfolio. That's how we define over the long run how the portfolio should look like. It also gives us a bit of a lighthouse, when things are getting, blurry or there's a lot of events, there's a lot of volatility, not to forget where we should be aiming at. It's very important to capture the upside of the market. So typically the best way to protect your portfolio from the next market correction is to have accumulated enough value to absorb that market correction. If you're always panicking about the next market correction and you're always underinvested, you never accumulate enough value into a client's portfolio to then sustain that, one moment where you have market correction. So that's really the strategy we try to apply. We tried really to look at what is really changing as we speak, what has changed over the last 12 months as we do that every year, how we're going to see the next 12 months based on that, and how we're going to see the next 10 years, which obviously is a big challenge, but that's how basically you can make sure you don't miss what's happening in the background. Because a strategic asset allocation, as it says, it should be strategic, and by that you should really having the long term as an objective. And in today's world, we have so much news coming to us every day through your phone, through your screen, that you need to be very careful not to miss, I would say, the big underlying trend which are changing, because those you don't see if you're too focused on your phone, basically. So the bank's approach and the investment committee approach is to be extremely holistic here, not to exclude anything. And if really we go into a scenario where we have a US recession, we have systemic risk out there like we had in 2011, 2012 with the urban crisis, then we would severely reduce the risk in our client's portfolio. But most of the time, we are in an expansion regime where basically markets are going up. Risk management is obviously an intrinsic part of how we construct our portfolio. And every time we want to add something, typically if we want to add gold to the portfolio construction, does it change meaningfully the volatility of the portfolio? Does it change meaningfully the risk parameters of the portfolio? Usually bonds are safer than equities, just as a rule of thumb, but there's always a given year where actually it's different. So we have basically 3 risk profiles per client. So income, balance, and growth. So one with, moderate level of equities around 35, the balance around 50, and the more growth-oriented around 75. Those will give, more or less a bit of a level of volatility to the clients, so we can more or less understand what could happen in very good years and what could happen in very bad years. So it's very important that the client understand what type of risk basically he's having in his portfolio. Some people might be risk averse and I would prefer something with lower volatility than others. The only way you can make sure that when you aggregate all the elements of the portfolio, that is robust, again, as I said, sustainable over time, and that itself it can handle the volatility which is in the market. Sometimes you just readjust top performer stocks, you reduce their weight because they've been doing extremely well versus the market, and you want to rebalance the risk in the portfolio. So it's more a matter of portfolio construction, risk adjustment, than just having, that's going to be the next trade, that's going to be the next company. Over trading usually destroys value versus, being stable and having the right construction, because the market is also made of different type of people in the market, people that are trading on the milliseconds and people that are wishing for the long run like us. It's true that sometimes looking at it, it looks a bit boring, but that's the whole point, is that level of boringness brings stability over time and deliver performance over time.